I'm Greg Fleming, Portfolio Manager of the SALT Sustainable Growth Fund. I do that in my capacity as Head of Global Diversified Funds for SALT. I joined SALT in 2015. The fund itself is a multi-sector and internationally diversified fund. It's a fund which we've deliberately developed in order to provide the most unusual allocations in the growth space in New Zealand, which includes both global bonds and equities, but also global listed real assets of infrastructure and property. SALT Sustainable Growth Fund has been built to give investors a diversified exposure to a number of fast-growing assets around the world that also have a quality dimension to them, also to preserve the reliability of their cash flows. So into the fund, as well as the traditional New Zealand equity asset class, we've built substantial allocations to global equities and bonds, and to global listed infrastructure and global real estate. That means for investors who are looking at a 5 to 7 year performance horizon, we can offer a CPI plus 5% expected return minimum over a 5-year time frame. So if you take the New Zealand inflation rate, we want a real return in excess of that of 5% per annum over that time frame. This has been delivered historically, and we believe that it is well within the power of this fund to generate that over medium term and longer term time frames. The investors who are likely to use this fund are investors who are reasonably tolerant of volatility in the service of achieving an advantaged return. But not investors that have to be risk-loving necessarily, because the fund is sufficiently diversified to offset the typical high-growth strategies that you see elsewhere in the market. That's because of its focus on infrastructure and property, as well as general broad global equity markets. So we would model this fund as having an expected volatility of around 11 to 12% per annum, which isn't excessively high, given that it does have an 80-20 growth to income strategic mixture. It does have several advantages though, because in its fixed interest component, we can take the allocation up quite high if we are in a defensive phase of markets. Similarly, we can take the real asset exposure higher than would be normal. It has 20% allocated to real assets normally. So investors who are interested in those regular cash flows, inflation resilient pools of assets that you typically see in global infrastructure would be particularly drawn to this fund. The underlying assets are slightly different to what you would see in a typical diversified growth profile. The reason for this is we felt that if you look at the market, international equities have increasingly been the go-to asset for growth, and the weighting to international equities has been creeping up over the years. We felt that you need to differentiate that international equity offering, and so we put in a 10% strategic weighting to each global listed infrastructure and global listed real estate or property. These are the traditional real estate investment trusts or REITs that you see in the US market. That means that those each have around 4 times the weighting that they would receive on a market cap weighted basis in the MSCI World Index. And it enables the managers to target stages of the economic cycle where listed real assets, inflation resilient assets, do better than typical growth companies around the world. We think we've got shorter, choppier economic cycles in play than what we've traditionally seen, and the ability to pivot between listed real assets and conventional global equities is a very useful feature of the fund. Also, sustainability criteria are important in the global parts of the fund particularly. We have a sustainable global fixed interest offering in the fund, and we have a sustainable global shares allocation. So the global fixed interest benchmark is 15% of the fund, and the global sustainable shares benchmark is 35% of the fund. Both of those mandates, which are managed for us by Morgan Stanley Investment Management, have clear guidelines under which they must seek out sustainable investment opportunities, and they are restricted from investing in carbon-heavy or environmentally harmful parts of the global economy. And we see that that thematic is very important. It enables us to reflect changing climate risks as well as just the general demographic trends which are dominating investment returns over the next decade. The investment process follows a regular cycle of review. We begin with a set of expected returns, and those we keep pretty much live. We use globally sourced capital markets assumptions from a variety of investment houses around the world. So we build a bottom-up basis expected returns for each asset class. Then we adjust those expected returns on shorter-term timeframes, depending on a range of indicators that we've tested to provide meaningful alpha into the fund. Now, these are reviewed on a monthly basis by our in-house investment committee, and were there to be a strategy change, we can have also ad hoc meetings. In addition, if there's an opportunity presenting itself, it doesn't have to wait for the month to roll around. We can have an ad hoc meeting and make a strategy change there. But from a macro point of view, myself and our economist Bevan Graham work very closely together. The broader investment committee are the other portfolio managers and investment professionals in the SOL team here in Auckland. But we do also have inputs from our global asset management partners, Morgan Stanley Investment Management on the bond and equity side, and Cohen Steers on the global infrastructure and global property side. Their capital markets assumptions are also taken into account in our fund modelling, as are their preferred tilts and their macroeconomic expectations and forecasts. So we align the weightings of the subcomponents in the SOL Sustainable Growth Fund with best expected returns or risk-adjusted expected returns over a 6 to 18 month time frame. That's the dynamic asset allocation time frame. That's kept live constantly, and it's adjusted with two-way dialogue between us and all of the external managers that are then integrated in-house, and our current positions will reflect all of those input sources. We've set this fund up because we had the opportunity to build a growth fund from scratch. We didn't have an existing fund in-house, and so we built it as you would build a growth fund if you had a free hand. It's been a great luxury. That means that we've only held the amount of defensive assets in the fund that we think actually are useful over a growth investor's time frame. It's not about reducing the measured volatility of the fund to hold those defensive assets. It's rather to provide diversification at critical moments. So that's enabled us to go into unusual types of equity asset within the fund. We have managed to have listed real assets at a 20% overall weighting, split between 10% in real estate and 10% in infrastructure, which is atypical and makes this fund quite unique, with sustainability labels on both of those. Similarly, in global equities and bonds, sustainability is an important feature, and that sets the fund apart in the marketplace too. We think that the time frame for investors now with shorter cycles need not be a decade or longer for this kind of value proposition. Rather, you can look at a 5 to 7 year horizon and still expect the returns that are the objectives of this fund. So it's set apart by those features. Finally, we have a theme of climate change resilience, and the business is generally good on sustainability as a fundamental principle of SALT, and for that reason we've put an alternative diversifier in the fund, which is the SALT Carbon Fund, at a small weighting, but nevertheless it is an uncorrelated asset, and it does provide genuine diversification scope, while at the same time signaling our commitment to lowering carbon footprint across the business and across the country.